The stock market has been on fire over the past month, and along with that, we've seen many quality companies start to increase their dividend payouts, with some being as high as even 13 or 15%. So in this video, we're going to be looking at 7 different dividend stocks that just announced dividend increases. So let's go ahead and dig in. The first stock we're going to look at that just increased their dividend payouts is going to be Starbucks. They just announced a 7% dividend increase. And if we jump over to Seeking Alpha, we can see the past year has been pretty rough for this company. They're down around 6.47%. Now we can see there was a huge sell-off here in late April, and this is when the company released a very bad earnings report. And around right here is when they let go of their CEO to bring on Chipotle CEO Brian Niccol, and that shot up the share price into the mid-90s. And since then, the company's done decent, currently trading at about $97.55 per share. And if we look at their most recent earnings report, they saw misses on top and bottom lines. Now, people weren't necessarily expecting a good earnings report because this company is really struggling right now. Now, if we go ahead and jump over to my dividend breakdown sheet, we'll come up here and plug in SBUX and hit enter. And we can see all this data will automatically load in. And like always, if you'd like to be able to download any of my automated spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. We actually just released a new update, and we're planning on releasing some new spreadsheets here in the next few weeks. Now, if we come down here, we can see Starbucks has a starting dividend yield sitting at about 2.5%. And if we look at the dividend history for Starbucks, there's no doubt they've done a good job of increasing dividend payments over the past decade. We can see a 10-year dividend CAGR of about 13.63%, but it started to slow down quite a bit in the past 5 years. Now, around an 8% dividend CAGR is still very solid, don't get me wrong, but there is a clear slowdown going here compared to the 10-year. And like we just saw, the most recent dividend increase was sitting at about 7%. So we have to start to question, is the dividend growth rate for Starbucks going to start to slow down? And based off a couple things, we can see in the short term why it's been lower. Look at this free cash flow payout ratio for 2024. It was around 78%. So the company had to use 78% of their free cash flow to pay out dividends. That is a high free cash flow payout ratio. There is no doubt. Now, free cash flow has climbed a little bit since 2022. We can see it was sitting at about $2.5 billion. And like we saw from the most recent earnings report, it was Q4, so we have full 2024 data. 2024 free cash flow came in at about $3.3 billion. Now, if we jump over to my stock screener, and you can see I've already plugged in Starbucks here, there's a couple good things going on with Starbucks that we'll be able to see, like the debt to assets ratio has come down a little bit lower in 2024, and return on invested capital was really good, which I'll point out here in just a second. But we can see revenue per share, not a lot of growth right here on a per share basis. Free cash flow per share actually declined slightly, and so did earnings. So there's definitely still some concerns here with top and bottom line growth. So why is return on invested capital so high if the company's struggling to grow things like free cash flow? We can see return on invested capital in 2024 was 42.73%. That means the projects they're reinvesting their capital back into right now are very profitable. Well, one of the things you have to understand is if a company has a very high free cash flow payout ratio, which technically makes it a little bit easier to have higher returns on invested capital. For example, if Starbucks wasn't paying out anything in dividends and they could use all their free cash flow to reinvest back into the business, they'd eventually start struggling to find areas where they could get returns that are this high. So yes, this ROIC is very good for 2024, but keep in mind, free cash flow payout ratio is very high. That's a little bit of a concern. It's also important to keep in mind that competition in the coffee industry is really starting to ramp up. And for example, Dutch Bros has done really well over the past year. They're up 75.52%. And they recently released their Q3 earnings, and they saw beats on top and bottom lines. And based off their earnings report, they're planning on becoming a bigger player in the food game. Our next stock is one of my favorites, and it's one of the largest holdings in my personal portfolio, and that is Visa. And they just announced a 13.5% dividend increase. So this was a big dividend hike for this company, and they've been killing it over the past year, and they're currently trading right at all-time highs. We can see over the past year, up around 26.22%, and year to date, currently up around 18.25%. And this company actually released their latest quarter's earnings, Q4, and we can see they saw beats on top and bottom lines as well. So let's go ahead and see what this means for Visa by looking at the dividend breakdown. I'll come up here and plug in V, and we can see the company has a starting dividend yield sitting at about 0.77%. So no doubt this is a lower yielder, but the dividend growth has been phenomenal over the past decade. Look at this, going from 42 cents per share all the way up to now sitting at $2.36. So they have a 10-year dividend CAGR of 16.8% and a 5-year of 14%. So you're getting explosive dividend growth from this company, and keep in mind, the share price appreciation over the past 5 and 10 years has been really good. They're up almost 400% in the past 10 years. Now, one of the things I love to see out of dividend growth holdings is when they're able to increase their dividends at a rapid rate without their free cash flow payout ratio increasing. And we can see their free cash flow payout ratio for the entirety of the past decade has remained below 30%. And the only way this is possible, a free cash flow payout ratio that's not growing while dividends are growing, is if they're growing free cash flow at a very high rate. And we can see this has been the case for Visa, going from around $6.6 billion in free cash flow in 2014 all the way up to about $18.7 billion in 2024. And when you think about the business model for Visa, this is pretty much a completely inflation-resistant company. They have inflation protection built in. Visa gets a percentage of pretty much every single payment, so as prices go up, Visa brings in more in revenue. And to put this into even more context, if we jump over to my profitability statement sheet and come up here and plug in Visa, yes, you'll see explosive earnings growth and revenue growth, but look at the gross profit ratio for this company. It's typically sitting around 80%. We can see last year it came in at about 77.52%, which is absolutely phenomenal, and the 10-year average for this company is sitting right at 80.6%. So we're talking about very high margins. Our third company that just announced a dividend increase is AbbVie, and they just announced a 5.8% dividend hike, and they've actually had some pretty interesting price movement over the past month. Look at this. In the past month, they're down around 10%, and in the past 5 days alone, down 12.59%. So what's been going on with this company? Well, AbbVie recently saw a large decline after missing its main goal in a schizophrenia treatment trial. If we scroll down, you'll be able to see why this was a big deal. Last year, they put up $8.7 billion for the acquisition of the company that had the schizophrenia drug. And like we just saw so far, this drug is not meeting their primary endpoint. So that's a lot of money to put up to not get very much return on investment. And if we scroll down further, we can see a quote from Wells Fargo. They think this failure was a big surprise and significant negative for AbbVie since it makes people question the pipeline strength. Now, pipeline is a key word for companies like AbbVie because their growth is entirely dependent on what's in the pipeline. What new drugs do they have coming forward? That's what's going to drive their earnings growth. And to make things worse for AbbVie, we can see one of their competitors, Bristol Myers Squibb, BMY, recently received FDA approval for a very similar drug, so BMY was up 13%. So not only that, but there's a lot of competition in this market, and that's why we saw a huge sell-off from this company. Now, recently they also released their latest quarter's earnings, and it was actually somewhat good news. They saw beats on top and bottom lines, which was a big deal because if you've been keeping up with AbbVie, their largest revenue driver over the past decade was Humira, and they recently lost their patent. We can see right here, Humira making up the vast majority of the company's revenue. And if we look at this charted out, we can see revenue from Humira has declined pretty steadily ever since they lost that patent just a couple of years ago. But we can see some other drugs have been picking up the slack, seeing some good growth in those areas, which is why they saw beats on top and bottom line. So that's good news overall for AbbVie. Now, if we dig a little bit deeper into the dividend metrics for this company by plugging it in, what you'll be able to see is exactly why so many dividend investors have loved this company over the past decade. Look at the starting dividend yield. It's very nice, sitting at 3.74%. But look at the dividend growth along with it. The 10 years at 15% and the 5-year at 9%. So a phenomenal combination of starting dividend yield and dividend growth, and a really good history of dividend growth too, with the free cash flow payout ratio only sitting at 47.7%. We can see free cash flow has been easily covering those dividend payments for the majority of this past decade, which is a great sign, something we want to see. Now, our next stock is going to be an oil company. We have Exxon Mobil, and they just announced around a 4% dividend increase. It came in at about 4.2%. If we look at Exxon Mobil over the past year, they've done pretty decent, up around 17.66%, and they also released their latest quarter's earnings, Q3, and they saw beats on top and bottom lines. Now, if we jump over to the dividend breakdown sheet for this company and look at XOM, and we can see the company has a starting dividend yield sitting at about 3.27%. Now, typically when I'm analyzing stocks, I like to look at the free cash flow payout ratio more than I like to look at the earnings payout ratio. But when we talk about energy companies, these are typically companies that have very high capital expenditures. And because of that, the amount they pay out in dividends will actually a lot of the times be higher than free cash flow. So sometimes I like to actually look at the earnings payout ratio when it comes to energy stocks. But in this scenario, we can actually see both payout ratios are sitting pretty close to 44 to around 45%, which is interesting. Now, this company has been growing dividends over the past decade, but not at a high rate. We can see the 10-year dividend CAGR pretty close to what we just saw, coming in at about 3.9%. And the 5-year sitting at about 2.92%. So this most recent dividend hike actually above the 10 and 5-year dividend CAGR. Now, one of the things we also have to understand about these energy stocks, if we look at my stock screener, the one thing I want to point out is these are very cyclical companies. They're very up and very down. And that doesn't necessarily mean that they're bad companies, but for an investor like me, I typically want to see consistency and predictability with the companies that I buy. Our next company is another one that saw double-digit dividend growth, and that is Automatic Data Processing. They saw a 10% dividend increase, so pretty big dividend hike coming from this company, and they've way outperformed the market over the past year, up over 35%, currently trading at $304.73. Now, like these other companies, they also recently released their latest quarter's earnings, and this was actually Q1 for their fiscal year 2025. 2025, and we can see they saw beats on top and bottom lines. Now, in other news you just need to be aware of when it comes to this company, their COO did just step down. I haven't seen any reason given for this or any negative reason, so it's nothing to be concerned about, but just something to be aware of. Now, if we jump over to our dividend breakdown sheet, we'll come up here and plug in ADP, and what we'll see is a pretty good example of a stock with a decent starting dividend yield with double-digit dividend growth. That is a great combination. Starting dividend yield coming in at 2%, and look at the dividend growth over the past decade, going from around $1.75 back in 2014 to we're now sitting at $6.16. So if you've been holding this stock over the past decade, from a dividend perspective, you've really been rewarded. We can see pretty much 12% 10-year dividend CAGR, and it hasn't really slowed down too much in the past 5 years, sitting at about 11%, and this most recent dividend hike was right in line with it, sitting at about 10%. So you've gotten pretty consistent high levels of dividend growth from this company over the past decade. Now, the free cash flow payout ratio is currently sitting at about 60.74%. Well, we can see for the past decade, that's pretty much the area that it's been sitting in. 60% looks like to be their target free cash flow payout ratio. If we go ahead and jump over to our stock screener, I've already plugged in ADP, and we can see top and bottom line growth has been pretty solid over the past decade. When you look at revenue per share, free cash flow per share, and earnings per share, all trending in the right direction, and contrary to XOM, like we just looked at, this is what I like to see. I like to see predictability and stability out of the earnings from the companies that I had in my portfolio. Because in reality, this is the most sure way to know that you're going to get consistent dividend growth moving forward. We can see the company has a very low debt to assets ratio, shares outstanding has been reduced, so they are buying back shares, and return on invested capital has been really good for the past decade, and especially in the last few years. Look at 2024. 47.48% return on invested capital. That is absolutely phenomenal. If we jump over to the profitability sheet, I've already plugged in ADP, and one of the things we'll also notice, the gross profit ratio has been getting better over the past few years. So when you talk about growing top and bottom lines, combined with your gross profit ratios getting better, the margins getting better, that's a formula for explosive growth. That is a really good sign. We can see 2024 gross profit ratio came in at 49.94%, while the 10-year average is 41.67%. So that's a really good sign from this company. They've been a great example of a dividend grower, and it looks like they're going to stay that way for the foreseeable future. Our next stock is another energy company, and that is Atmos Energy, and they actually saw a really nice dividend hike coming in at 8.1%. And if we look at this company over the past year, typically you're not going to see that much growth from an energy company. They're up around 32%, and if we look at them year to date, up around 24.41%. Now, this most recent quarter finished their fiscal year, and we can see they beat on their fiscal year expectations by around 3%, and it is expected to grow if you look at the future outlook right here. Now, if we come over to my dividend breakdown sheet, we'll come up here and plug in ATO. And again, all this data will load in. And the first thing you'll notice is these charts over here look a little bit weird. Now, why is this? Well, like I mentioned earlier, energy companies can have very high levels of capital expenditure. So a lot of the times they'll even have negative free cash flow. For example, if we just look at 2018, free cash flow was negative $342 million, while dividends paid out was about $214 million. So in reality, the best way to judge the safety of the dividend a lot of the times for these energy companies is actually going to be with your typical payout ratio. And we can see that's sitting at about 48.58%. So it does look a little bit more sustainable than the free cash flow payout ratio would tell us over the past decade. So this company's actually had a pretty good combination of starting dividend yield and dividend growth over the past decade, especially for an energy company. Starting yield of 2.41%, and the 10-year dividend CAGR is sitting at about 8.78%. They've grown it even faster over the past 5 years at about 10%. So we can see pretty solid dividend growth when you look at that charted out. And the biggest dividend hike of the day that we're going to see was 15.1%, and this came from Snap-on. So that's a huge dividend increase, and we can see the past year has been really good for this company, up around 35.2%. But look at just the past month, up 25.86%. Now, this company did release their latest quarter's earnings fairly recently, but we can actually see they missed on top lines, but they did beat on bottom lines. So if we go ahead and jump over to our dividend breakdown sheet, let's come up here and plug in SNA, and you'll see this company has been a dividend growth machine over the past decade. Starting dividend yield is sitting at about 2.07%, but look at that dividend growth. The 10-year dividend CAGR is sitting right at 15%. That's really high levels of dividend growth over the past decade, and like we just saw, it looks like they're keeping this up with their most recent dividend hike. So that's a great sign. The past 5 years, 13.62% dividend increase, and the entire time, the payout ratios have remained very low. Again, payout ratio staying low while increasing dividends at a high rate is a phenomenal combination. So you really get everything you could want out of a dividend growth stock when you look at these three metrics. Decent starting dividend yield, phenomenal dividend growth, and the payout ratios are remaining low. Like I said, we can see that's been the case for the company over the past decade. Look at that dividend growth, going from around $1.58 all the way up to $7.44 in just a 10-year time period. And of course, all of this has been backed by free cash flow growth. If we jump over to my stock screener, let's go ahead and come over to our profitability sheet and plug in S&A. If we look at Snap-on and the average 10-year gross profit ratio, it's sitting at about 49.33, but again, it's been increasing over the past couple of years, a wonderful thing to see, sitting about 51.28% as of the last year. And finally, if we jump over to my stock screener, we'll see not only have they been rewarding shareholders with a growing dividend, but they've also bought back a decent amount of shares over the past decade, going from around 58.2 million down to about 52.9 million. Again, keep in mind, buying back shares is going to boost all other per share metrics like earnings per share, revenue per share, and actually even enhances their ability to be able to pay out dividends moving forward. So there you go. Those are 7 companies that just recently announced dividend increases. Go ahead and let me know what you think of these companies in the comments down below. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight to your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.